G'day everyone, my name's Mitchell Snedden and I'm joined here today by Head of Research James Carlisle and Deputy Head of Research Gaurav Sodhi, and we're going to be talking about the Intelligent Investor Equity Income Portfolio and the Intelligent Investor Equity Growth Portfolio. Now, James, I might start with you. Can you please tell us how has the Intelligent Investor Equity Income Portfolio gone recently?
Well, the equity income portfolio and the growth, actually, they've been pretty similar. It's gone okay recently. I was a little bit ahead of the market, I think, in November. We just put a blog update on our website today. But, you know, the month before it was a little bit down. The month before that it was a little bit up. I mean, it's been bobbing along the last few months. Over the last year, of course, the market's been pretty strong and we've pretty much matched that. And we're still a few percent ahead of the market since inception 2.5 years ago in both portfolios.
Right, well, Gaurav, I'll just go to you. One thing that's been coming up on the phone with our investors and potential investors a lot recently is the fact that the Australian market and global markets are at quite elevated levels. And that's been holding a few people off from, you know, they like our approach, they like the portfolio, want to invest in the portfolio, but that's really playing on their mind and holding them back. What are your thoughts on when it comes to investing at what the people are telling us are elevated times?
I like the instinct of being wary and perhaps a little bit fearful when markets are high. I think that serves you well. But I would say as an investor in an active fund, and remember the funds we manage at Intelligent Investor, the income and the growth portfolio, are actively managed. They're really concerns that you pay us to worry about. I mean, your returns as an investor in the fund is going to come from stocks that aren't in the fund today and that will be in the fund over a long period of time. We're turning over a lot of stones looking for ideas. We are finding ideas. We are making additions to the portfolios. The stocks we have in there now are performing really well. The fact that markets are expensive makes it harder to find inclusions, but doesn't make it impossible. And because you're in an actively managed fund, we're actively screening out those stocks that are elevated, unattractive, and perhaps a little bit dangerous. And we're actively putting in companies that have been neglected, that are a bit more interesting, and that may have some option value. And you can see that from the inclusions that we've made in the fund. So I'd say it's the right thing to worry about, but the wrong person doing the worrying. We're the ones worrying about those sort of things, and we have strategies in place. We've been doing this for a while. Our whole process is determined around overcoming that particular problem. So if you're an outside investor thinking about timing the market, you don't really need to worry about that because the fund is managed by us and we make those
we don't time the market. I think that's the main point I would make is that you can't time the market. You know, you have investments that you think should be in long-term assets, invested for the long term. Over the long term, the evidence from the past is that shares, over properly long periods tends to outperform cash, and it's very hard to tell. In fact, probably impossible to tell when it's going to put in those sort of periods of outperformance that mean that it does that. So, the decision is what assets you should have invested for the long term, what assets you should keep back and invest for the short term. The decision isn't around whether the market is high or low at the moment, because those timing the market in that way hasn't been a successful strategy in the past.
Now, James, we'll stick with you. Looking at the Intelligent Investor Equity Income Fund, that word income attracts a lot of attention, but especially with our demographic, with the InvestSMART and the Eureka Report Intelligent Investor crowd. They're all they're managing self-managed super funds predominantly, they're looking for income. How hard is it to find attractive income stocks right now?
Well, it depends what you mean by attractive income stocks. I mean, yields on bonds have come down over the last 30 years. Really, the last 30 years have been a story of falling yields on all assets, and the last 5 years have been particularly so. So yields have been getting lower and lower, and naturally that makes it harder to find income-producing assets. If you're looking for 8%, you're not going to find it now on something that isn't extremely risky. In the past, you might have got that from relatively easy, a long time ago in the 70s. So our aim with the income portfolio is to have a safe yield, which hopefully will grow over time, at least in line with the economy. and the yield on the portfolio is only about 4%, but that's all you can really expect to get with that kind of with a safe yield that rises a little. If you're getting a yield much more than that, then you better not expect it to go up too much. So, that's what we would. Those are the sorts of stocks we're looking for. We're looking for stocks that produce the cash flow that can support that kind of yield. But it's harder now to get the high yields because all yields on all assets are down. But that's for good reason. So
I think one of the mistakes income investors often make is having their own requirement and then investing to match the requirement of a 7 or 8% yield. The market is unaware and agnostic about your own circumstance, and it's risky to that additional 1 or 2 percentage points of yield attracts a whole lot more percentage of risk. And so one thing we actively try and avoid, and we're very cognizant of, is reaching a little bit too far, a little bit too greedily for yield when it attracts a lot more risk. And I think it's tempting as an income investor to just grab the highest yield you can get. That is a mistake.
Now, Gaurav, we'll stick with you. A new stock that's actually come into the portfolio. You went around on our roadshows just recently and spoke about it, and I think it goes really right to the heart of what we try and do, and is think differently from the rest of the market. And the new stock that you presented at that roadshow and is in, I believe, both portfolios is Woodside. Just want to give us the quick back of an envelope why Woodside is attractive to you, but really it's kind of been shunned by the broader market.
Yeah, the market has a consensus view on Woodside that says that the company is not producing more oil and gas, and that's true. Its production profile is rather static. More worryingly, the market thinks that the reserve position has been declining, and that's also true. The reserve position has indeed been declining, but we make the case that the value in Woodside is not the reserves in the ground, it's the infrastructure above the ground. And the quality and the scarcity of that infrastructure means that there's ways to address the production problem that aren't yet in the price. You don't need to grow your reserves to result in high output when you have terrific infrastructure and nearby gas fields. So we've come up with a few scenarios to illustrate ways Woodside can achieve more production growth and more profitability that aren't necessarily reflected in its current reserve position or its share price at the moment. So this is a business that's been completely neglected for its quality because of specific concerns, and we don't share those specific concerns.
Now, James, another thing that's been coming up on the phones quite a bit recently, I want to get your take on how much exposure especially the income portfolio has to cryptocurrencies.
Are people really asking that, are they?
Yeah.
Is that...
It's not specifically about our portolios, because I'd like to think our investors would know a little bit better than that.
So we're proud, well, not particularly proud. I mean, why would we invest in cryptocurrencies? Because they're not an investment. They're a bubble. They are what they are. They can't be a currency because currencies have to have a clear value. You have to know what they're worth at any point in time, and certainly no one has the faintest idea what a Bitcoin is worth. So there you go. We wouldn't touch it.
We've already spent too much time talking about it right now. Excellent, guys. Thank you for joining us, and investors, we'll catch you next time.